Well, we mentioned stocks are in a positive mood this morning, investors that is, after the inflation data that crossed. Right now we're looking at a pretty strong move for the S&P and TSX. And after 3 challenging months, we've got equities now putting together what's been one of their best months so far of the year. What kind of momentum could we see heading into the end of 2023? Let's get some insight and analysis. Carol Schleif joining us, Chief Investment Officer at BMO's BMO Family Office unit. Carol, great to have you with us. Let's start with the market responding very well to some inflation easing in the latest data in the United States. How are you viewing all this right now?
Well, it's definitely nice to see the relief and markets focusing really on the glass half full that we've seen in the past few weeks in particular. But it's important to remember that even with the more positive surprise to the CPI today, that core rate of inflation is still running at twice what the Fed wants it to be. And so we do think you'll see a lot of volatility in markets between here and year end. They'll be pretty headline driven. Everyone's counting on getting another CPI report before the Fed meets next, but getting that CPI report is going to be predicated on whether or not we can keep the government open past Friday. So there's a lot of issues. There's a lot of issues.
That little thing, yeah.
Right, just one little thing, but a lot to be looking at.
Yeah, well, it is very true, and we'll see what happens as we get to the end of the week. But how are you positioning portfolios right now in light of what you're highlighting? And that is the daily reality. Like would not be surprising to hear from some Fed speaker with some hawkish rhetoric, pushing back on this inflation data, and all of a sudden the mood of the markets changes again. So how are you positioning portfolios right now?
And it is interesting because you mentioned the Fed governors, and there's a lot on the talk circuit even today. So we'll get a lot of news and a lot of take on that as parsed by the various Fed people. But we've been positioning portfolios. We've never been in the camp that thought we were necessarily going to have recession. We started calling over a year ago that the Fed would be able to orchestrate a soft landing through here, and that scenario is playing out. But there is a lot of volatility likely in there. And positioning portfolios, we're running portfolios that are intermediate and very long term. And so we don't want to necessarily pull all the way back from that growth scenario because we didn't believe that you were going to see a recession per se. So we've got a balanced approach to risk where we've been up until recently shorter on the maturity curve because you weren't getting paid to take the risk of going out longer, but you were getting paid substantially to be sitting shorter term. But we've also got a toe in growth assets. We've been neutral to overweight U.S. equities for a very long time, and being very careful about where we're taking the risk and balancing it with some conservative nature so that we're building durable portfolios that are resilient for whatever the outcome is.
So as we saw, like on our television, for our television audience, just on the screen there, that would include maybe looking at a sector like healthcare, but also looking at, we mentioned that you've got, once again, some of these AI names that are moving higher, like NVIDIA, just being positioned to play what feels like a fairly promising future for that kind of technology.
Yeah, and we're definitely looking at secular themes because when you look at the spending, the fiscal stimulus and fiscal spending that's teed up in the United States in the form of 3 various acts that have been passed over the last couple of years, there's a couple of $1 trillion worth of incentives and tax cuts and other things aimed at rebuilding and building out new industries, rebuilding existing industry. You're seeing it starting to creep into the productivity numbers because we had a nice surprise on those productivity numbers. But technology, cybersecurity, artificial intelligence, advances in healthcare, a lot of that stuff is putting a pretty nice infrastructure in place for the longer term. So we want to make sure that we're positioned to participate in that. But there's a lot of short-term hype around this. It's important to remember that a lot of what's driven the markets, both in the first 5 or 6 months of the year and more recently, has been that Magnificent Seven, and that if you neutralize the market cap weighting in in the S&P in particular, the average stock hasn't done much year to date. So there's room for a broadening of this as long as the economy can avert a recession.
Carol, before I let you go, let's move from the Magnificent Seven to that magnificent market known as Japan, at least in 2023. Actually, this came up recently on our program, Market Call, a bullish view. You heard about Warren Buffett investing in some of the equities there, and the overall performance has been quite strong this year. How are you looking at that market, and what are your thoughts on the outlook?
We actually made a tactical call 4 to 6 weeks ago where we went from underweight Japan, which most of the globe is, to a neutral weight in Japan. So we increased our exposure there because, as you touched on, there are secular issues going on in Japan with over half of the Japanese publicly held stocks trading below book value. And now there's mandatory proposals that those companies need to put forward, for example, on what they're going to do to improve their book value, their stock price value relative to book value. So there's a lot of interesting things, a lot of secular things going on in Japan that we think finally are going to make it worthwhile taking a look at as far as being able to call it out from the developed market indexes, because we're less favorable on Europe and what's going on there, but very favorably disposed towards Japan.
Carol, great to have you back with